Hi everybody, this is Alan Ellman, the Blue Collar Investor. In Lesson 6 of the Beginner's Corner Information Series, we're going to discuss how to execute a covered call trade. Before we do that, let's review the course from Lessons 1 through 5. We first learned the basics of options and covered call writing. Then we selected the best covered call candidates based on both fundamental and technical analysis, as well as common sense principles. And finally, we used our calculations to determine our portfolio returns as well as our portfolio makeup. Now it's time to go to our computer, log in to our online discount broker, and start generating cash into our brokerage accounts. Now there are two basic types of orders we could place. One is called a market order, which is an order to buy or sell a stock or option at the current best available price. If you remember when we looked at the options chain, there was the bid and the ask columns. We sell at the bid. So a market order, we would get the bid price. The other type of order is called a limit order, and that's an order to buy or sell a stock or option at a specific price or better. Now, most of the time when I buy a stock, I'll use a market order because the bid-ask spread is pretty tight or close together. But when I sell an option, I usually enter a limit order because I can oftentimes negotiate a better price, something we'll discuss in a few moments. Now, there are two types of online forms depending on the brokerage you're using. One is called legging in, and that's the one we're going to concentrate in this video because it gives you a better understanding of how the process works. In the legging in form, we first buy the stock, and then once owned, we sell the corresponding call option. The other type of form is called the buy right combination form, where we execute both the purchase of the stock and the sale of the option at the exact same time for a net debit or an expense. For example, if we buy a stock at $30 and sell the call option for $1, the net debit would be $29. And I'll show you a form filled out how that works. So first look at the legging in form, and here is an example where we first buy the stock. You see at the top the transaction in action is buy stock. We put in the ticker symbol of that stock and the number of shares we want to buy. In this case 300, which will allow us to sell 3 contracts. The type of order was a market order because the bid-ask spread was close together. I want you to notice there are two types of accounts on most forms, a margin account and a cash account. Here the margin account is checked off, but in most cases it will be, for most retail investors, the cash account. Margin accounts are a little risky for average retail investors. Now, once we've entered the order, we check the activity status of that order. And in this slide here, you can see an example of a purchase that was activated and concluded. In this case, 300 shares of Kirkland's Inc. was purchased at $15.36 per share for a debit amount of $46.1305. At this point in time, we know that we now own the stock and we can move on to sell the option. So in this case, the transaction and action is to sell a covered call option. The underlying symbol is placed and the expiration date. The strike price is put in with the number of contracts. Since we bought 300 shares, we could sell 3 contracts. Now the order, you see, I checked limit order. Again, oftentimes we can negotiate a better price than the bid from the option chain. In this case, I put in $1.15, and the duration is a day only. Now I want you to take special note that under qualifiers it says all or none, and that box is not checked. It's very important not to check that box if you're going to try to negotiate a better price in the bid-ask spread. Let's move on now to the buy right combination form, which some brokerages use. And in this case, we're going to buy the stock and sell the option at the precise same time. So at the top of the form, you see that we're going to buy 300 shares of BCI. The action is buy. In the middle part of the screen, we're going to sell to open, or to start a position. We're going to sell 3 contracts of BCI. And at the bottom of the screen, you see the duration is for day only, and there are no special instructions. Now, in this case, let's say that we bought the stock for $29 and we sold the option for $1.50. That would give us a net debit of $27.50. And on the right-hand column, you could see we put in a limit order. What that means is we're going to spend $27.50 or less in order to execute this trade. If the brokerage can't do $27.50 or less, the trade will not be executed. Now, on the other hand, if we've entered into this position and now we want to exit it, we would exit it via a net credit. At the top of the screen, you see we're now going to sell the 300 shares, and we're going to, in the middle of the screen, buy back the 3 contracts. Once again, the duration is for the day only, and there are no special instructions. In the right-hand column, you'll see that we entered a net credit order for $28.40, which means that we're going to receive $28.40 or more in order for this trade to be executed. So in this case, if the trade was executed at $28.40 and the net debit was executed at $27.50, we have a profit of 90 cents per share, or $90 per contract, $270 for the 3 contracts. Now, there is some commissions, but because we're using an online discount broker, those commissions are negligible. So let's talk now about negotiating a better price in the bid-ask spread. I usually use this strategy when the bid-ask spread is greater than 10 cents. Here again, we use a limit order, and we do not check the all or none box. We're more likely to get a better price if that box is not checked. And what we do is we enter a price slightly below the midpoint of the spread. So let's take a look at the left-hand part of the screen now. You'll see at the bottom that we have 3 arrows, and if you look at the red arrow, you see the bid column says $3.10 and the ask column says $3.40. Well, that's a bid-ask spread that I can work with. So what I usually do is I say, where's the midway point? Well, there's 30 cents between the spread. 15 cents is the midpoint, so $3.25 would be the midpoint. What I'll do is I'll enter a limit order of $3.20. I'll drop it slightly below the midpoint. And I will not check the all or none boxes. You see on the right-hand side, the third from the bottom, the all or none box is not checked. And that will give us a better chance of executing a trade that will give us a better price than what the options chain shows. Now, as I said before, it's critical that we use an online discount broker, because if you're going to be doing the covered call writing strategy, you're going to be executing a lot of trades every month, and you're going to be generating a lot of cash into your account every month, and we don't want to give a lot of that back to the brokers. So what we look for is, first, low trade commissions, very important. But we also want to watch for hidden fees and minimum requirements, so read the fine print before you sign up with an online discount broker. These brokers should also offer prompt and courteous phone service. Every once in a while, you'll need to talk to a representative. Ask about their advanced platforms if you're interested. Some of these brokers have very good services where you could do a lot of your own screening using their advanced platforms. Now, over the years, I've done a lot of live seminars, and many of those that attended had recommended certain brokerages to me that they've had very good experiences with. I actually have that in a file that I'm happy to share with you. And for free information, all you have to do is write me at alan@thebluecollarinvestor.com, put in the header online broker file, and include your name, and I'll be happy to mail you the file. So in summary, covered call trades can be executed either by legging in, doing it in 2 separate steps, or using the buy right combination form. Most of the time this will be a product of which form your particular broker uses. Orders can be entered as market order or limit order. Once again, I usually use market orders for purchasing stock or selling stock because normally the bid-ask spread is pretty close, but I use limit orders for the option side. Whenever possible, try to negotiate a better bid price. Remember not to check the all or none box. Select an inexpensive but reliable online discount broker. In Lesson 7, we're going to discuss a very important topic, exit strategies. Take care, everybody.